After we have an overview of the background on financial management in the last two chapters, we'll go to the technical topics from now on. They are more interesting, I'm sure. Today, let's have a look on the daily routine work of a finance manager, working capital management. Okay, let's start. By the way, what is working capital? Don't ignore this tiny thing, the definition. During the exam, whenever you see a technical term, no matter how simple it is, it's a good practice to briefly explain the definition before your detailed discussion and analysis. This is to let the examiner know that you understand the concept correctly. Do you still remember the accounting definition of working capital? It should be current assets minus current liabilities. From the financial statements of an organization, you will find either net current assets or net current liabilities on the balance sheet, depending on whether the amount of current assets is larger than the amount of current liabilities or not. As mentioned before, there are four areas of working capital to be studied on financial management. They are inventories, receivables, payables, and cash. But I would like to make it clear that there are some other items of current assets and current liabilities in the financial statements. They are not within the FM syllabus only because we assume that they are not significant and will not adversely affect the short-term funding. Why do we need to manage working capital? What's the objective? We always say that because we have to strike a balance between liquidity and profitability. What does it mean? Liquidity means we shall have sufficient cash or near cash to settle the liabilities. Near cash refers to the current assets which are easily converted into cash, for example, marketable securities. Pay attention to the keyword sufficient. Sufficient means enough and enough only. Because too much cash on hand being idle may make them become non-productive without reasonable financial return. The overall profitability of the organization may be reduced accordingly. However, if you go for high profitability by maintaining low cash balance, might raise the probability of default payment when the liabilities fall due. That's why we have to manage the working capital properly to strike a balance between liquidity and profitability. The level of working capital investment ideally should not be too high or too low. Later we will learn some financial models on individual area which may help us achieve this objective. If an organization's working capital is not sufficient, we name it overtrading. That means they are running the business without sufficient short-term funding in support. In the opposite, if there are abundant working capital, we call it overcapitalization. That means too much capital being idle. We will explain these two symptoms in more details by the end of this chapter on working capital funding. Before we go to learn cash operating cycle, let's have a quick revision of some financial ratios. They are not only the basics for the calculation of cash operating cycle, but also help us understand the underlying concepts behind. How can we measure working capital in terms of financial ratio? Usually, we calculate the current ratio or quick ratio. How to calculate? Any idea? The formula should be current assets over current liabilities. If quick ratio is to be used, we should deduct the amount of inventory from the current assets because we assume that it may not be easy to realize the inventories for cash in just a short while. Another ratio is inventory turnover. It indicates how long the inventories will be kept in the warehouse before they are sold. The formula is using the closing stock or average stock if it's available in the exam question over the cost of sales and times 365 days. The result represents the average number of days the inventories are kept in a year. The longer the inventory turnover, it means more money to be invested in the inventories. The next ratio is receivable turnover. It's also called debtor collection period. The ratio, in terms of days, shows the average period of time that we have to wait until the trade debts are received from customers. The debtor balance, or average debtor if available, is divided by the annual sales value and then times 365 days. Payable turnover is similar to receivable turnover, but on the opposite side. We should use the creditor balance, or average creditor, over the annual purchase value times 365 days. The ratios represent how long we pay our suppliers in a year. That means our suppliers are financing our operations. Alright, why should I recap your memories of these financial ratios? Because we need them to calculate the cash operating cycle. Cash operating cycle is the number of days that to be financed on working capital. What does it mean? Let's put it into a formula. The cash operating cycle is the sum of the inventory turnover and receivable turnover minus the payable turnover. As all the three turnover ratios are in terms of days, the length of the cash operating cycle is also indicated in number of days. The cash operating cycle represents the net period of days that need our investment to finance the operations. The longer the cash operating cycle, the larger amount of working capital is required. Therefore, some textbooks also name it working capital cycle or the funding dates. Can you follow? If not, let me show you a diagram. It may provide you with a solid picture of the operating cycle. What do we need to start a new business? Inventories. Do you agree? Let's take a manufacturing business as an example. The inventories will be in form of raw materials. After the purchases, if credit period is provided by the suppliers, trade payables will be recorded in our books. Payment will only be made sometime later, for example 30 or 60 days later. In other words, the suppliers are lending us money to purchase these materials. Come back to the manufacturer. The raw materials will be processed and transformed into WIP and finally finished goods. The production process takes time. That's why manufacturing business usually has a longer cash operating cycle than trading business. The finished goods will be kept in the warehouse until they are sold to customers. The length of the time starting from the purchase of raw materials until the finished goods are sold is inventory turnover. When the finished goods are sold, if we assume that the sales are on credit, trade receivables will be taken up in our accounts. After a certain period of time, the receivables will be settled by the customers. This is the receivable turnover. Within this period, before the trade receipts, the company has to finance the operations on their own. That's why we need working capital. Then we may use the cash received from customers to settle our trade payables. Finally, the gap among the inventories, receivables, and payables is the cash operating cycle that requires our investment in working capital. Now, let me put them all in numerical figures and mathematical calculations. First of all, we purchase the goods on credit, no matter they are raw materials or finished goods. Sometime later, we settle the payment to our suppliers. Then, if we successfully find the customers, we may sell the goods to them, assuming on credit. So, at the end of the credit period, if luckily no payment is in default, we will receive the cash from the customers. Let's summarize and interpret the above business operations in terms of turnover period. The period starting from the purchase of goods until the goods are sold is the stock turnover period or inventory turnover. The time difference between our payment for goods and cash received from debtors is the cash operating cycle. Put them into mathematical calculation. The period of inventory holding plus the receivable turnover less the credit period from payables is equal to cash operating cycle in number of days. Are you clear now?